This video looks at intragroup inventory transaction occurred during the current period. The example that we have taken here is on 1st of July 20XO. Michael raised share capital to acquire 100% of Samuel's business ownership. And keeping the remaining balance as cash. The investor firm is called Michael Parent and the invested firm is called Michael Subsidiary. At the date of acquisition, Samuel's business had 200 million of share capital, 290 million of retained earnings. So the shareholders' equity is 490 million. Assets comprised 480 million of land and 10 million of inventory. So the total assets are 490 million. And there were no liabilities. Therefore, the net assets are 490 million, represented by shareholders' equity 490 million. During the year 30th June 20X1, following transactions took place. Michael Subsidiary sold 10 million of inventory to Michael Parent for 20 million. Michael Parent first recorded the inventory purchase as cost of sales in the income statement and transferred it to the balance sheet at the end of the year. You have received the financial statements for Michael Parent and Michael Subsidiary for 1st July 20XO, that's at the date of acquisition, and the year ending 30th June 20X1, that's 1 year after acquisition. Income tax rate is 30%. Required 1. Prepare consolidation journal entries and the consolidated financial statements for 1st July 20XO at the date of acquisition. 2. At the end of the year, 100% of inventory is unsold. Prepare consolidation journal entries and the consolidated financial statement for 30th June 20X1. That's 1 year after. 3. At end of the year, 60% of the inventory was sold at the price it bought. Prepare consolidation journal entries and the consolidated financial statement for 30th June 20X1, 1 year after. So the financial statements at the date of acquisition of Michael Parent and Michael Subsidiary, in that Michael raised 520 million of share capital and invested 500 million in the subsidiary and 20 million remained as cash. Michael's subsidiary, previously Samuel's business, had 200 million share capital and 290 million retained earnings, and that was represented by land of 480 million and inventory of 10 million. On 1st of July 20XO, the date of acquisition, there's only one transaction, consolidation transaction, to be done. That's the elimination of investment in Michael's subsidiary at fair value of net assets of the subsidiary. Investment in Michael's subsidiary is 500 million. Share capital at that date was 200 million and retained earnings at that date was 290 million. So there was investment more than the shareholders' equity. That is for collection of assets that's not identifiable separately, and that's the goodwill on consolidation. If you look at the worksheet, consolidation worksheet, we can see that Michael parent and Michael subsidiary, Michael share capital of 520 million represented by investment and cash 520 million. And then on Michael's subsidiary had land of 480 million and inventory of 10 million, and that's represented by share capital of 200 million and retained earnings at the date of acquisition of 290 million. We must now eliminate the investment against the shareholders' equity in the adjustment columns. So we credit 500 million against the investment in subsidiary, and we debit retained earnings 290 million and debit share capital 200 million. And then the remaining amount on that is the goodwill on consolidation, and that's 10 million. Once that is done, we can add the rows across, keeping in mind the accounts, whether they are debits or credit balances, and then the adjustments as debit or credit. What we find here is the share capital of the group is 520 million. It is represented by land which was in the subsidiary 480 million and inventory 10 million, and the goodwill now being made transparent of 10 million, and then the cash that was there in Michael subsidiary of 10 million. So because Michael parent and Michael subsidiary is just one entity, a group entity, it's all about Michael. What we see is the consolidated position, financial statement position, is represented by Michael's share capital, which Michael raised, and they're represented by what Michael had, which is 20 million of cash, and then what Michael took control over on the subsidiary, which is 480 million of land and inventory of 10 million, and then the goodwill that was embedded in the subsidiary of 10 million. On 30th June 20x1, the end of the first year, entire inventory is unsold. So this is the second part. In that, we have the Michael parent and Michael subsidiary financial statements, 30th June 20x1. You can see at the end of the year, Michael still have the share capital of 520 million, and then used that cash, which was 20 million, to buy inventory, and he bought inventory 20 million. When he bought inventory, he recorded first as cost of sale inventory, and because it was unsold, that was transferred from the income statement into the inventory 20 million. So this was transferred to inventory. On Michael subsidiary, we have the share capital of 200 million and retained earnings of 290 million. But Michael subsidiary sold the inventory for 20 million. So that's 20 million here. And that 20 million is revenue for Michael subsidiary, became cost of sales for Michael parent. So there's a trading transaction here. Michael subsidiary made a profit of 10 million. On that, there's income tax expense at 30% is 3 million. And the retained earnings in Michael subsidiary is 7 million. And because Michael has now entered into a transaction, there is income tax expense, and that income tax expense become income tax payable. Let's look at the consolidation entries. The first entry is the elimination of investment against fair value of Michael's subsidiary equity. We can start with this entry because there are no fair value adjustments for the subsidiary in consolidation here. We credit investment in subsidiary 500 million. We debit share capital 200 million and debit retained earnings 290 million, and the remaining amount is goodwill 10 million. And that's our elimination entry. Then are the entries relating to the inventory intragroup transaction. So there was a trading transaction that took place where Michael subsidiary earned revenue, and we need to eliminate that, and then the cost of sales that Michael parent has recorded. So our entry is debit revenue and credit cost of sales to eliminate the intra-group inventory trading transaction. Third is to eliminate gain on sale of inventory. The inventory is now included a gain, and this 20 million here is including a gain of 10 million, whereas the actual value of the inventory is 10 million. So therefore, we need to decrease the inventory by 10 million. And then the cost of sales of inventory has been recorded as 20 million. It should also be reduced because the gain is included in this cost of sales. So therefore, we debit the cost of sales 10 million to increase the cost. Therefore, the gain is reduced. If you look at the inventory value, because there was a sale from subsidiary, Michael subsidiary, to Michael parent, the tax base of the inventory is 20 million. But the carrying value of the inventory is 10 million. Because the carrying value for the group has not changed. But because it's a real transaction, the tax base has now increased by 10 million. Now the carrying value is less than the tax base, and that difference becomes a deductible difference. Applying the tax rate, that gives us the deferred tax asset of 3 million. So we debit deferred tax asset of 3 million and we credit income tax expense of 3 million. If we apply these four transactions into the consolidation worksheet with debit and credit adjustment columns, we can see that we eliminate the investment first against the shareholders' equity, 290 million and 200 million, and there is a difference of 10 million goodwill on consolidation. Our second entry is to eliminate the trading transaction revenue and cost of sales. So we debit revenue 20 million and we credit cost of sales 20 million. Our third transaction is to eliminate the gain on sale of inventory. We need to debit cost of sales of 10 million and credit inventory of 10 million. So on the worksheet, we debit cost of sales 10 million and we credit inventory 10 million. We're increasing the cost of sales 10 million is to reduce the gain. Because our carrying value of the asset is lower than the tax base, there's deferred tax asset of 3 million. So the fourth entry is to record the deferred tax asset of 3 million and we credit that to income tax expense 3 million. Now we can add across and keeping in mind the debit and credit accounts and the debit and credit adjustment entries. And finally what we get is shareholders' capital is 520 million and the shareholders' capital of 520 million is the shareholders' capital of Michael parent 520 million. And what we have is then the land of 480 million. Our inventory is showing up now as 10 million, which was the original value. Our cash, which is in parent, Michael parent, is still there as 20 million because it was not used. But we have deferred tax asset of 3 million, deferred tax asset of 3 million, and income tax payable of 3 million. The reason we are having income tax payable of 3 million is because Michael parent actually sold it and then incur income tax payable because it's a legal entity. So that's over there. But the income tax expense through the consolidation got eliminated and that income tax expense got deferred as deferred tax asset. Michael Group has not sold inventory, but when it is sold, then only Michael Group will receive a benefit, and that benefit of tax is now included in the deferred tax asset as a future tax benefit. Our third point is on 30th June 2021, the end of the first year, 40% of inventory is unsold. The third part is on 30th June 2021, the end of the first year, 40% of inventory is unsold. For that part, our consolidation journal entries, the first one is to eliminate the investment. We credit 500 million, we debit share capital 200 million, and we debit retained earnings 290 million, and the remaining amount is goodwill on consolidation 10 million. Our second consolidation journal entry is to eliminate the inventory trading transaction. We credit cost of sales 20 million and revenue 20 million. Third journal entry, consolidation journal entry, is to eliminate the unrealized gain on sale of inventory that is held. What is held now is 40% of the inventory, and on that, the original value of the inventory is 10 million, and the unrealized gain included the total gain of inventory is 10 million, and it's only 40% is now being held. So therefore, we need to eliminate only 40% of that unrealized gain. So we credit inventory 4 million and we debit cost of sales 4 million because it's unrealized gain By doing that, we are increasing costs to decrease the gain. If you look at the inventory held, is 40% of the inventory carrying value is being held and is 4 million, and the tax base of the 40% of inventory being held because of the sale, it was sold for 20 million, but it's only 40% that's remaining. Tax base is 8 million, and the carrying value is less than the tax base, and that difference is a deductible difference of 4 million. Applying the tax rate, the deferred tax asset is 1.2 million. So we debit deferred tax asset 1.2 million, and we credit income tax expense 1.2 million. So these 4 consolidation journal entries we can now include into the worksheet, consolidation worksheet, to the debit and credit adjustment columns. So we start with the first entry, which is the elimination of investment entry, 500 million credit, 200 million debit for share capital, and 290 million debit for retained earnings at the date of acquisition. 500 million is the investment in the subsidiary that we credited, and the remaining amount is the goodwill on acquisition, 10 million. Our second journal entry is to eliminate the trading transaction. So we debit 20 million revenue and credit cost of sales 20 million. Our third journal entry is to eliminate the unrealized gain that is now restricted to 40%, and the total unrealized gain was 10 million, and we need to debit cost of sales 4 million, and we credit inventory 4 million. Our fourth entry is the deferred tax asset arising from the deductible differences. We debit deferred tax asset 1.2 million, and we credit income tax expense 1.2 million. Let's now include the consolidation journal entries in the worksheet. In the consolidation worksheet, we got the Michael parent and the Michael subsidiary financial statements as at 30th June 20x1. We can see for the Michael parent, the 520 million of share capital. It was invested 500 million, and then it bought from the cash 20 million previously. It bought inventory worth of 8 million, is originally 20 million. There's 8 million unsold, so that 8 million is now transferred to the balance sheet, 8 million. So what Michael parent has earned, because it sold at the same price as it bought, there's no profit. There's no profit earned by Michael parent. For Michael's subsidiary, it's sold inventory 20 million at a cost of sales of 10 million, and profit before tax is 10 million, and the income tax expense is 3 million, and the retained earnings for the year is 7 million. Now, because income tax expense is 3 million, it's a real transaction, there's income tax payable of 3 million. Michael subsidiary still has the land, and there is cash that was earned by sale of revenue of 20 million. Let's now look at the adjustment entries. Our first adjustment entry relates to elimination of investment. we credit 500 million investment, and we debit share capital 200 million, and we debit retained earnings 290 million. The remaining is goodwill on consolidation 10 million. Our second journal entry relates to eliminating the intragroup inventory trading transaction. We debit revenue of 20 million and we credit cost of sales of 20 million. Our third transaction is to eliminate unrealized gain on sale of inventory which has been held, and that's only 40%, and the total gain for 100% of inventory held is 10 million. So for 40% held is 4 million. We debit cost of sales to decrease the gain and credit inventory to decrease unrealized gain included in inventory. So debit cost of sales 4 million and we credit inventory 4 million. Our fourth consolidation entry relates to a deferred tax asset. We debit deferred tax asset of 1.2 million and we credit income tax expense 1.2 million. If you look at the group now, we can see the group earned 12 million of revenue. That's the revenue that it earned by selling revenue outside the group, and the cost of sales of that revenue is 6 million, and the profit before tax is 6 million. The income tax expense for this is 1.8 million. It's 1.8 million because 1.2 million is being held as deferred tax asset. So 1.8 million plus 1.2 million equals 3 million income tax payable. So 3 million is the income tax payable because there was a real transaction for Michael's subsidiary. It's income tax payable. But out of that, Michael parent sold 60% of inventory. On that, there is income tax expense, and that income tax expense is 1.8 million. That is in the current year. But there is 40% of inventory which is unsold. And on that, although Michael's subsidiary would be paying income tax because it recorded a transaction, income tax payable would be 3 million. But 1.2 would be for the future because 40% of inventory is unsold, and that 1.2 million would be deferred tax asset in the group financial statement. Then the goodwill on consolidation is recorded, land is recorded, and the share capital of Michael parent is representing the share capital. And the retained earnings have for the current year is 4.2 million after deducting the other expenses of the shareholders' equity becomes 524 million. The inventory value is 4 million because it's only 40% of 10 million inventory that's been held, which is 4 million. And the cash has increased because there was 20 million of cash. There was 12 million of revenue, and that 12 million of revenue became cash. So 20 plus 12 is the total cash, which is equal to 32 million. So what we see is that the deferred tax asset here is income tax payable credit is represented by income tax expense of 1.8 million and deferred tax asset of 1.2 million. But if it is 100% of inventory being held, income tax payable 3 million would be completely a deferred tax asset of 3 million because that inventory will be sold in the future. But in this instance, 60% of the inventory has already been sold. And therefore, deferred tax asset component is smaller, and 60% of that rise the income tax expense. That brings us to the end of the video, and thanks for watching.